One of the most satisfying things is going to your account and seeing a company paid you a dividend. And now we are in a weird part of the economic cycle, and I just want to get to the point of exactly what is going on with REITs. Now, REITs are really reliant on the 10-year treasury and the debt market, and with the 10-year treasury spiking up, we're seeing REITs now sell off, and they've been an underperformer over the last 2 years. Now, in this video specifically, I want to dive into the headwinds I personally see with Realty Income. This is arguably the most popular REIT out on the market. It's a monthly paying dividend, and a lot of individuals rely on this monthly dividend income to supplement retirement. So I want to go through what's wrong with the business model, where the red flags are, and just be completely transparent as possible. Hopefully you guys enjoy. And if you're new to the channel, welcome in. My name is Colton. We take a fundamental approach on compounding capital while looking at long-term price action. Now, what I want to point out is the 5-year price action on Realty Income. First and foremost, this hit a high of nearly $80 a share and now is down to $52 a share, which is leaving a hefty 6% dividend on the table. Is this a good time to enter? What is going on with the company? Well, we're going to get into that right now. And with Realty Income, we see that this dividend not only has been paid for 26 consecutive years, but has also been raised 26 consecutive years, which makes it a pretty unique stock overall. Now with REITs, there's a lot of things to consider: maturity of debt, who's their tenants, what portion of their portfolios based on those tenants, how exposed are they to certain sectors. And so we're gonna get into that in Realty Income. And this is personally where I see the red flags. I wanna point out the pros before we get into where my concerns are. The pros are the revenue has grown from $944 million to $1.26 billion in the 3 months ended versus 2023. When we bring it down to a funds from operation, we can see they're not being as efficient. And when we go from adjusted funds from operation, yes, we see an increase from adjusted funds from operation, but not as big of an increase as we should see considering the revenue growth that took place here. But this is definitely a pro. They are still growing revenue. The question is, can they make the funds from operations more efficient? Now, they gave us guidance for 2024, basically looking to do anywhere between $4.17 to roughly $4.29 normalized funds from operations. So if we just break out a quick calculator, currently the stock's trading around $52.50. We divide that by the $4.20, basically meeting in the middle as they guided for $4.17 to roughly $4.29. I'm meeting in the middle here and saying they're going to do right around $4.20, which gives it a valuation of 12.5 times forward funds from operations. Now, I don't think this is a screaming deal. I think this is a decent buy. Buying this type of quality company at a forward funds from operations sitting at 12.5 is very reasonable. No questions asked. I'm not going to deny that. So to go over the pros, this is a company that's been fiscally responsible, paying out dividends for 26 years, raising those dividends for 26 years, growing its revenue still, and getting a decent funds from operation valuation currently where the price is sitting today. So let's get into concern number one. Concern number one is a lot of the big box retailers are having big problems, including the dollar store, as Family Dollar and Dollar Tree will be closing 1,000 stores. And we can see here that Dollar Tree and Family Dollar are one of their largest customers, with 3.1% of their portfolio exposed to those two big box retailers, along with Dollar General, who is having their own problems as well. But the big one is obviously going to be Walgreens Boots Alliance. Walgreens is looking to close right around 2,000 stores. And other brands we have to start thinking about, along with the Dollar Tree, Dollar General, Walgreens, is going to be companies like CVS, Rite Aid. There's definitely a shift now with the consumer. Everything is direct to consumer. Big box is not needed as much. Don't get me wrong, in certain locations, obviously it's going to be convenient to have big box retailer exposure, but it seems like more and more locations are closing down for multiple reasons. People are just not out spending as much. They're doing more online shopping. Seems to be a big tick up in theft. And so where these companies are losing money and where these stores are not really running efficient, they're starting to close down. If Walgreens is talking about shutting down stores, Dollar Tree, Family Dollar is talking about shutting down stores, CVS is talking about shutting down stores, Red Lobster and AMC having their own problems as well. Yes, they are losing some of these clients, but are they making up enough? And are other customers growing? When we talk about like a BJ's Wholesale, when we talk about an LA Fitness, can these companies offset the possible lost revenue that we're seeing with these other companies closing up stores? Now, this is definitely one of the larger problems I see with Realty Income. A big exposure to big box retailer, a big exposure to restaurants, and we're seeing kind of a shift here in the consumer that could leave them a little bit exposed. But that's not the biggest problem I have. The biggest problem I have is going to be their debt maturities. Now, we saw a substantial spike in the 10-year treasury today, but what I want to point out is over the last 25 years, we've been in an ultra low interest rate environment. And when we think about Realty Income, that means the 26 years they've been paying dividends, they haven't had to deal with these headwinds of higher interest rates. So what does that mean? This means that their expenses are most likely going to go up as they start refinancing debt, and we're going to go over the maturities, which we've done before, but I just want to recap really quick. They've been able to navigate a pretty easy interest rate environment for the last 25 years, but now we're starting to see that government spending could leave a bid under the 10-year treasury. Now, are we going to stay around 4.5? I think we'll probably stay around 3.75 to roughly 4.5 for the next 3 to 5 years. When we factor in the amount of debt that the government is issuing, I just don't see how we're going to get yields back to that 20-year low again, and that's where REITs really accelerate. They're basically able to borrow money for free and keep up with inflation by raising rents. But the problem is they haven't been able to keep up with the high inflationary market, and they've been navigating through a high interest rate market, which means that the rents are not keeping up. They're actually losing tenants, but their expenses are going up because interest rates are higher. And so I just want to glance over here and show you exactly what I'm talking about. In 2024, they're only going to have around $469 billion of debt maturities due. That average rate of maturity is at 4%. Well, the problem is the 10-year treasury is sitting at 4.5%. So we could be looking at closer to 6, maybe 6.5% debt that needs to be refinanced. This is over 50% more expenses that we have to look at when we're looking at investing in Realty Income. And where the scary part comes is a big chunk is coming in 2025 and 2026. This is a substantial amount of debt at very, very low interest rates, which means that it's been an easy market for this company, and now expenses could be going up while they're losing tenants, which is two headwinds that I think could actually make the price go a little bit lower here. And then when we look at their later maturities, 2028, you're looking at 3.19. In 2027, you're looking at 2.85. I'm just not so sure we're going to see that low of interest rates anytime in the near future, which then makes REITs possibly an underperformer when we think multifaceted here. Multifaceted meaning there's definitely a shift with commercial real estate that's in big question here. And we're in a higher interest rate market, which to me is boding for two massive headwinds for a company like Realty Income. Now, I didn't make this video to scare anybody. I'm just making this video to show you exactly what I'm personally looking at when I look into a company like Realty Income. I actually like the debt maturity for a company like Vici a little bit better. And I also think Vici's not as exposed to those big box retailers, but none of those problems I don't see in the near term. The near term, I think there's some issues here for a company like Realty Income. And when I speak near term, I'm talking 2 to 5 years. So let me know what your thoughts are. Realty Income, are you investing in it? Are you thinking about buying the dip? Are you looking to add in? Are you looking to build it out as a new position? Give me your thoughts on Realty Income. Would love to know what your thoughts are on the company. Overall, I do think this is a great company, but I do think there's also headwinds here that you need to consider. As always, guys, really appreciate your time, and we will see you in the next one.